One article getting a lot of traction on CNBC.com this morning is from our own Hugh San, titled "The Fintech Reckoning is Upon Us." Hugh, some pretty amazing stats, such as 20% of all VC dollars last year went into fintech. Easy money, it felt like any company with an idea, whether that was really a platform or just sort of a product, got funded. What does that mean going forward next year? If this reckoning really is upon us, does the target change? Does the model change? Instead of being a one-stop shop, as sort of every fintech wanted to be, are they more open to things like acquisitions?
Hey, Deirdre, great to be with you. I would say, look, after the party comes the hangover. And of all the VCs, founders, and investment bankers I spoke to, they believe that this reckoning, that this series of mass consolidation of companies needing to shut down or to sell themselves is going to happen within 6, 9, perhaps 12 months. And so I think it has a lot of ramifications. You're seeing all these companies going into their back end and saying, how can we extend runway? How can we actually become more profitable? The problem with them during the party days is that they had poor unit economics. Basically, it was let's growth hack our way into a business. Let's use marketing and purchase users, not unlike rideshare companies a few years ago, and get to scale and then figure out how to make money from them. And so now that the cost of money is no longer zero, you're seeing that they basically don't have a lot of pathways to profitability, and you're seeing them basically look at a future of having to shut down. Deirdre?
Yeah, speaking of a cost of money being zero, how much of this, no longer being zero, how much of this reckoning is really about interest rates and the fact that these companies' business models were built on low interest rates?
Well, yeah, some of the VCs I spoke to were flabbergasted that, when they had the time to do due diligence with their possible, investment cases, that, the people who founded these companies, they lived and they grew up basically during the summertime of free money and had no conception of what it would be like to have a true cost of capital. And so when you see the ramifications in fintech, which obviously has, the first part of that is finance, it's pretty dramatic. First of all, what happens to your cost of capital if you lend money to marginal borrowers? What happens to your loss rate when, for the first time, they start to have delinquencies and actually default on their loans? So you've got a firm up on the screen. Look, that's down 80, 90%, and that's not as bad as even as some of these other companies that have SPAC'd this year. So it is everything. The interest rate is everything.